Hello everyone. In this video, I'm going to examine should we be investing in small stocks? The IWM, the ETF that is the Russell 2000, which contains smaller stocks, has been going up recently even when the techs have been selling down. Now, there are subsectors within the Russell 2000, and there's an ETF in biotechnology, in home building, and in regional banks, which have also taken off. And you may want to invest in those in addition to IWM or instead of IWM or in all of them if you're completely into the small stock thesis. Now, small stocks stand to benefit from interest rates decreasing. They have to borrow a lot of money because they are small stocks without huge cash reserves, unlike the large technology companies, which actually benefit from high interest rates because they have large stashes of cash that they can benefit from the interest gained on that large stash of cash. One area that's been benefiting strongly from the prospect of lower interest rates is home construction. We know that as interest rates are lowered, more people qualify to buy houses, and so more houses will be constructed, and that's what's been happening. In Phoenix, there are some areas of Phoenix that have just been booming with the home building. Looking at the chart, you can see that it's well above its 50-day moving average. It's made about 19% in the last month. It's gone up from around $100 to $119. So, wow. And this will continue if interest rates keep coming down. Again, this is all conditioned on we don't go into recession, and we're going to get that major indication this Friday from the Sahm rule. ITB's relative strength is 70, which is not overbought yet, but it's rapidly getting there. Biotechnology has been benefiting from the prospect of lower interest rates. The S&P Biotech ETF is XBI, and it's gone up over 9% in the last month. Its relative strength is 66, which is good, and it's well above its 50-day moving average, of course. This is a speculative stock. Biotech tends to move around quite a bit in my experience. So I have to strongly believe interest rates are going down to invest in this one, but it is potentially very profitable. Regional banks will benefit strongly from lower interest rates. The ETF for regional banking is KRE, and it's gone up about 20% almost in the last month. It's gone up from about 50 to a little bit over 59. Its relative strength is 77, so it's quickly getting to being overbought. But if interest rates keep going down and we're not going into recession, it will keep going up. This sector was punished severely by the recent bank failures of Signature Bank of Silicon Valley and several other prominent regional banks. So this area was severely punished. There was a lot of shorting going on. Small stocks have been doing relatively poorly compared to the other stocks, the large cap stocks, until recently. So they've been severely punished, and they've been shorted more than the larger stocks. And so now with them starting to be increased, you're getting short squeezes. The people that have been shorting are going to experience massive losses if this continues. And they've probably been shorting these smaller stocks because they have been doing poorly. You know, it's a momentum thing. They're doing poorly, so they probably will continue to go down, so they're shorted more. And when the price goes up, they get squeezed and they have to buy back into the stocks, which sends the stocks violently upwards. Friday, we'll be looking to see if the Sahm Recession Indicator is triggered. It will be triggered if the unemployment rate goes up from 4.1%, goes up to 4.2%. That will trigger the Sahm Recession Indicator. The Sahm Recession Indicator signals the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more relative to the minimum of the 3-month averages from the previous 12 months. A simple way of remembering this, it's an indicator that all of a sudden unemployment is shooting up. And it's important the speed with which it shoots up, because what they find with unemployment is that in a recession, it starts to go up just a little bit at first, but then it cascades and goes up rapidly. And all of a sudden, you're looking at 7, 8, 9% unemployment. We have quite a week coming at us with all kinds of news, including the Federal Reserve Board will tell us what they're going to do with interest rates on Wednesday. It's expected that in this July meeting, they're just going to leave interest rates the way they are. But the important part will be the interview, because the market has already priced in 3 rate cuts for the rest of 2024. So every meeting that the Federal Reserve has left, they're predicting that they're going to cut it by 1/4 point each time to have a total of 0.75 interest rate cuts. I think Jerome Powell is going to signal that they might reduce interest rates at the September meeting, but I think he's going to be kind of vague. I expect it to be a little bit of a positive event, not a big deal. The big deal will be the earnings. On Tuesday, we have Microsoft. On Wednesday, we have Meta. And on Thursday, it's the Super Bowl, Apple and Amazon. So these massive earnings are going to be the big deal. But we're going to be looking at that Sahm rule on Friday, because we will have had the big technology companies are already reporting, and we will be seeing if small stocks are going to hold up if that Sahm rule is triggered, because small stocks aren't going to do as well as is being predicted by Tom Lee if we're in the midst of a possible recession. Thanks for listening.